OpenAI just raised $6.6 billion at a $157 billion valuation. Their annual revenue? $3.4 billion. That means investors are paying 46 times revenue for a company that burns through $7 billion a year just to keep the lights on. But here's the kicker. They're not even close to being the most overvalued AI company. We're witnessing the most expensive tech bubble in history, and most people don't even realize it's happening. So how did we get here? How did entire industries start throwing money at AI companies with no clear path to profitability? The answer reveals everything wrong with Silicon Valley's current obsession, and why the crash, when it comes, will make the dot-com bubble look like a minor correction. Let me paint you the picture of what's really happening. It's 2022. ChatGPT launches and breaks the internet. Within 60 days, every venture capital firm in Silicon Valley is scrambling to find the next OpenAI. Partners who couldn't spell transformer 6 months ago are suddenly AI experts, writing checks for $100 million based on demos that barely work. The numbers from this feeding frenzy are staggering. In 2023 alone, AI startups raised $50 billion globally. 2024, we're on track for $75 billion. That's more money than the entire GDP of most countries, flowing into companies that, in many cases, have never turned a profit. But here's where it gets weird. The more you dig into these companies' actual business models, the more the math stops making sense. Take Character.AI, the chatbot platform that lets you talk to AI versions of celebrities and fictional characters. They raised $150 million at a $1 billion valuation in March 2023. Sounds impressive, right? Here's what the investors didn't advertise. The company was burning through $20 million per month, with virtually no revenue strategy beyond a $10 monthly subscription that barely anyone was paying for. The math is brutal. To justify a $1 billion valuation, Character.AI would need to generate around $200 million in annual revenue. That means converting 1.6 million users to $10 monthly subscriptions. They had millions of free users but couldn't convert even 100,000 to paid plans. 6 months later, Google bought them for parts, and this story isn't unique. Anthropic, the company behind Claude AI, has raised over $2 billion from Google and Amazon. Their revenue? Estimated at less than $200 million annually. That's a 10x revenue multiple for a company competing directly with OpenAI in a race to the bottom on pricing. Now pay attention to this next part. The fundamental problem isn't that these companies don't have users. Many of them do. The problem is, the economics of AI don't work the way traditional software economics work. Traditional software has beautiful unit economics. You build it once, and serving additional users costs almost nothing. Gmail can handle 1 billion users because serving email is computationally cheap. AI is the opposite. Every conversation with ChatGPT costs OpenAI approximately 3 to 4 cents in compute costs. Every image generated by Midjourney costs them real money in GPU time. This creates a nightmare scenario. The more successful you become, the more money you lose. Stability.AI, the company behind Stable Diffusion, found this out the hard way. As their image generation service exploded in popularity, their compute costs exploded with it. They were generating millions of images per day, burning through $2 million monthly in GPU costs alone, while struggling to monetize their free-to-use model. The CEO, Emad Mostaq, quit in March 2024. The company laid off 40% of its staff. Reports suggest they were weeks away from bankruptcy before raising emergency funding. But wait, there's a catch. The venture capital firms know this. They're not stupid. So why are they still writing these massive checks? The answer comes down to 3 words: fear of missing out. Every VC remembers passing on Google, Facebook, or Amazon in their early days. The potential upside of finding the next trillion-dollar AI company is so massive that rationality goes out the window. Andreessen Horowitz, one of Silicon Valley's most prominent firms, has raised a $7.2 billion fund focused primarily on AI investments. Mark Andreessen himself said AI is the biggest technology shift since the internet. The fear is that if they don't invest now, they'll miss the entire wave. Here's what nobody is talking about. The infrastructure costs aren't getting cheaper, they're getting more expensive. NVIDIA, the company that makes the GPUs powering all this AI, has a near monopoly. Their H100 chips, essential for training large language models, cost $40,000 each. Training a single large language model requires thousands of these chips running for months. The tab? Often over $100 million per model. And this is where the economics get truly insane. These models become obsolete within 12-18 months. GPT-3 was cutting edge in 2020. By 2022, it was already being replaced by GPT-4. That $100 million investment, it's depreciating faster than a luxury car. Meta learned this lesson expensively. They spent over $13 billion on Reality Labs in 2022, much of it on AI infrastructure and research. The result? Llama 2, a capable model that they gave away for free because they couldn't figure out how to monetize it profitably. Now this is where most people get it wrong. They assume the solution is simple, just charge more. But AI is caught in a deflationary spiral. OpenAI's API pricing has dropped 90% since 2022. Google, Amazon, and Microsoft are all racing to offer cheaper AI services, subsidized by their massive cloud businesses. The result? A race to the bottom where everyone loses money. Except for NVIDIA, which sells the shovels in this gold rush, and the cloud providers, who can afford to lose money on AI to lock in customers for other services. Stop and think about this for a second. We're looking at an entire industry built on the premise that someone, eventually, will figure out how to make money. But what if they don't? The warning signs are already appearing. In the first quarter of 2024, AI startup failures started accelerating. Inflection AI, which raised $1.3 billion, essentially shut down and sold its team to Microsoft. They couldn't find a viable path to revenue that justified their massive infrastructure costs. Jasper AI, the content generation darling that was valued at $1.5 billion in 2022, laid off 41% of its workforce in early 2024. The reason? ChatGPT and other general-purpose models were eating their lunch at a fraction of the cost. And here's the kicker. The companies that are surviving are doing it by abandoning their original AI-first business models. Character.AI sold to Google. Inflection's team joined Microsoft. Smaller AI startups are pivoting to traditional software with AI-enhanced features. Let me show you why that matters. The real profitable AI companies aren't the ones trying to build the next ChatGPT. They're the ones using AI as a feature, not the entire product. Companies like Notion, which added AI writing assistants, or Adobe, which integrated AI into Photoshop. They have existing profitable business models and use AI to enhance value, not replace their entire economic foundation. But the venture capital world hasn't gotten this memo yet. They're still chasing the dream of finding the next OpenAI, even as OpenAI itself struggles with profitability. Sam Altman admitted in a 2024 interview that OpenAI might need to raise a lot more money to achieve profitability. This is the company that supposedly represents the success story of AI entrepreneurship, and even they can't make the math work. The numbers tell a different story than the hype. Across all major AI startups, the combined monthly burn rate exceeds $2 billion. Most have 12 to 24 months of runway remaining at current spending levels. What happens when that money runs out? We're about to find out. The venture capital market is already tightening. Series B and C rounds that would have been automatic in 2023 are getting scrutinized. Investors are finally asking the uncomfortable question: how exactly are you going to make money? And for most AI startups, the honest answer is, we don't know yet. This isn't sustainable. You can't build a trillion-dollar industry on speculation and hope. Eventually, someone has to pay the bills. And right now, it's mostly venture capital firms hoping someone else will figure out the business model later. The closest historical comparison is the dot-com bubble of 1999-2001. Companies with no revenue were trading at astronomical valuations based purely on growth potential. When reality set in, $5 trillion in market value disappeared virtually overnight. The AI bubble might be even worse because the infrastructure costs are so much higher. A dot-com company could fail with relatively small losses, maybe $50–100 million in total investment. AI companies are burning through billions before they even launch their first product. So, what's the lesson here? If you're thinking about investing in AI stocks or working for an AI startup, understand the fundamentals. Most of these companies are essentially research projects with billion-dollar valuations. The technology is impressive, but impressive technology doesn't automatically translate to sustainable business models. The winners in AI won't be the companies trying to replicate OpenAI's model. They'll be the companies that figure out specific profitable applications for AI technology, and that can afford to lose money for years while they figure it out. Microsoft is probably the smartest player in this space. They invested $10 billion in OpenAI, but structured it as a partnership where they get access to the technology while OpenAI bears the development costs. They're selling AI-enhanced versions of Office and Windows at premium prices, while someone else pays for the underlying infrastructure. Google and Amazon are following similar strategies, using AI to enhance their existing profitable services, rather than betting everything on AI-first business models. The bubble will burst. The only question is when and how many billions will be lost in the process. My prediction: we'll see massive consolidation in the AI space within the next 18 months, with most standalone AI startups either shutting down, getting acquired for parts, or pivoting to traditional software models. The technology is real, the applications are powerful, but the current economic model is unsustainable. And in Silicon Valley, unsustainable always ends the same way, with a crash. I want to know, do you think AI companies will figure out profitable business models, or are we watching the most expensive bubble in tech history inflate in real time? Drop your prediction in the comments. And if you want to understand how technology bubbles really work, subscribe. We break down the economics behind the hype every week. Next video, we're exposing how social media companies manipulated their own user data to inflate engagement metrics during their IPOs. The internal documents tell a very different story than what they told investors.